today's special webinar event, why more investors are turning to commercial. And it is a special event because normally at Hot Spotting, we focus on residential real estate. But increasingly, I'm finding that property investors across Australia are seeking more than the traditional passive investment. Buy a house, put in a tenant and wait for it to grow. More and more investors are seeking investment options that offer a twist, something extra or special. And I think that commercial property certainly offers that potential. To tell us about that potential, a special guest today is James Dawson, who runs the Commercial Investing Academy. James is one of Australia's foremost experts on commercial property investment, and he acquires extensive knowledge on the subject by actually doing it himself. He's built an extensive portfolio of strong commercial investment properties. But I will let him tell us about it. James Dawson, welcome to today's webinar. Good to have you here.
Great, thanks, Terry. Thanks for having me on. Thanks for the lovely introduction. And yes, I think you're absolutely right. There seems to be quite a bit more interest in commercial investing. And just a little bit about myself, I guess, that like most people, I started in residential investing. And because that just seems to be the way that everyone gets to become a property investor. You know, it's relatively easy to get into. It's what we read in the papers. It's what we're taught, I guess. If you talk to real estate agents and all that, it's all about buying residential property. So I essentially started about 40 years ago doing just that, buying residential properties, and always been a bit of a renovator on my 101st renovation right at this moment. And you're only seeing the good side of the room at the moment, where this is coming from. But I had a lot of issues early on with residential property in that I sort of hit the glass ceiling, I guess, in what I could buy. And also the cash flow just wasn't strong enough. So I was having to buy and sell. I was forcing myself into a situation to buy and sell. And that eventually got me into commercial property, where I found that I was able to get much higher cash flow and therefore keep funding purchases. So a few things to talk about today. And one of the first things I'd like to just chat about is why do people actually invest? So I think that actually gets a bit lost. I mean, I know I talked to a lot of people about property investing, and people just say, oh, look, I'm just going to go and buy something, whether it's a house or commercial. And look, I love all types of property. I've got residential myself, of course. So, you know, it's just interesting to have that little chat. You know, why invest in property in particular? It's another little topic. Why I like commercial and favour that myself as an investment vehicle over residential. Talk about the misconceptions and fears, I guess, that most people have when you mention you're a commercial investor. And I think the best way to demonstrate and I guess open people's eyes to commercial investing is actually to use real life examples. So I've got some of my own deals in here, some deals that have just been done, or some properties that are actually for sale, and a little bit about my course as well at the end. But I'll just run through these. I've got so many pictures on my computer of all these properties that I've either bought and sold or still have, but I've had all sorts of types of properties. That first one's the first top left corner. There's the first commercial property I ever bought. And I've just proceeded on from there. Potts Point in Sydney, Newcastle, Bondi. This is my latest deal, which is up north of Brisbane. It's a childcare and a 13-shop shopping centre that really needed repositioning. And that's been a very profitable deal and a very good deal. So I can show you a bit more about that a bit later on. But I initially, as I mentioned, started renovating, and here's me with a beautiful full head of hair with a house that I bought in, I think it was Lawson Street, Hamilton, way back in the 80s. And what I was doing actually then was I'd buy these houses. I can remember that house, I paid 65 grand for that at auction. And I typically spend, 20 grand. I was doing it all myself on the weekends. I was a real estate agent at the time, so I'd get stuck into it on the weekends. I'd paint them up, fix them up, rent them out. And then the only way to move forward was to sell them to take the profit. So, usually make on that sort of property, 30 grand profit, and then I'd move on. But I got tired of that. The photo below, that's a block of flats I bought when I was 24, and I lived there whilst renovating that. That's in Beach Street, Newcastle, and another block that I did. I've done some horrific renovations, which has taught me a number of lessons. This one was a real money pit, one of my properties in Byron that I still have, and that was just an incredible dump that turned into a great property. So I love property. This is actually, in this next picture, before we move into the commercial guts of this, is my 101st renovation. This is another one in Byron. So I absolutely love property and everything about it. But the key is really, you know, why are you actually investing in property? I mean, if you're a renovator and you're buying properties to, you know, buy and sell and make a profit, that's great. But is it sustainable when really what I think most people actually want to invest for is to provide money to either replace their job income, maybe replace their partner's income, and just build wealth for themselves and their family. Now, these couple of pictures I got here, I hope you can see them okay. I just got these out of the Fin Review the other day, and it's quite interesting seeing that, you know, on the left picture there, that $500,000, say, in your super balance a few years ago would apparently last you 18 years. Well, recently they reckon now it's only going to last you 13 years. So, you know, we're all pretty fit as we get older. So if you're retiring at 65, you're sort of going to run out of money, you know, pretty quickly. And the little slide on the picture on the right there just gives, according to the Fin Review anyway, or whoever worked this out, is how much money a couple would need to live on. So in a nutshell, this is after mortgage payments, I guess, but about $62,000 a year. So where I'm getting to with this is, if you were someone that was, say, looking to set up an investment portfolio of some properties, you know, it's pretty easy to work out what you might need to live on. So if you wanted to build a portfolio and survive nicely in a retirement, you might say, okay, I want to develop a passive income of, say, $70,000 or $100,000 a year, whatever you select. So that's something to aim for. And with commercial property, it definitely is achievable. So, you know, I think everyone's probably listening to this has probably perhaps got some property investments. And, you know, I think it's just good to touch on the benefits of property as an investment. And one of the biggest benefits is, and I think people sometimes forget this as well, is that, you know, it can be highly leveraged. So, you know, on a residential property, for example, I guess you can borrow potentially up to 90% of the property's purchase price, probably generally around 80. But also with commercial, you can actually do the same. You can borrow generally on average about 65, but up to 80% of that property. So it's really a great way to leverage your money to get ahead. Now, also with commercial property, you can genuinely get good, genuine, positive cash flow. Now, I know a lot of people bang on about the benefits of negative gearing, and it certainly is a benefit if you're a high income earner. But to my mind, investing is a business, and I don't like businesses that lose or cost money. So I think that's a very important point. Now, when you see some of the numbers on some of the deals I'm going to show you, just moving through the slides, you'll see that there's, you know, genuine positive cash flow, you know, not that sort of $50 a week, something like that. You know, it can be hundreds of dollars a week, $1,000 a week with the right property. You just got to know what you're doing. And of course, you can have growth and stability as well with residential and commercial property investment. So why do I like commercial? Well, as I mentioned, you know, I sort of hit the ceiling with, I guess, lack of cash flow and also lack of ability to borrow because I didn't have the cash flow. So I sort of hit the ceiling, and then I, like a lot of residential property investors, you know, you start to sort of, I guess, get into this method of getting ahead by churning almost. You think, well, I better sell this property so I can buy a better property. And of course, you're costing yourself all the money to get into the property and then all the money to get out of it. So that's not such a great thing. And refinancing often wasn't such a good thing because it was hard to refinance because of your cash flow. So I like commercial because it's got higher yields, better cash flow, and it genuinely able to be positively geared. Long-term tenants, 3-year to 5-year to 10-year leases. There's a variety of types of commercial property. I'll run through those quickly a little bit later on. The commercial property investment is driven by a very powerful document in your commercial lease, and rent increases and terms and conditions are all locked in via that document. And look, it does favour the landlord. Commercial lease favours the landlord much more than, say, a residential lease does. Really good opportunities for capital growth, and a lot of people initially when they hear commercial, they don't believe that. They think there's no opportunities for capital growth. Low maintenance, in fact, the tenants do a lot of the maintenance, and when you're focused on commercial properties as an investment, the tenants pay for all the outgoings on that property by way of you obtaining a net rent. So I will touch on that later on. But I reckon, in a nutshell, there's 3 ways that a commercial deal will actually give you some profit. So firstly, when you buy a commercial property that is positive cash flow, from the day of settlement, you're going to be getting positive cash flow into your bank. Now, secondly, if you are able to buy a property that you've been able to identify what I call upsides, you'll be able to manufacture some growth in that property. And sometimes, as I'll show you one of my deals, you could get perhaps 5 or 10 years growth in a couple of years if you know what you're doing. And of course, a blend of both of those things is almost the perfect way to increase your cash flow and increase your equity as well. So there's those 3 things to focus on. So income really and manufactured growth, and a blend of the 2 is fantastic. One little point I'd like to make here is that when you're looking at the investment market, probably around 90% of people are looking for residential deals, and generally in the market, it's maybe around 10, it could be 15%, are looking at commercial. So from that, you're not sort of in that massive group of people that are running around looking at one sector of the property market. So you're sort of in this section that's a little bit more rarefied, I guess. And don't get me wrong, there's still this competition in the commercial market, but you're putting yourself a little bit apart from the main group of investors, particularly in Australia. So just a great little point there, because if you're trying to get ahead, obviously less competition is better for you. Excuse me. Now, often people ask me, they say, James, what are the types of commercial properties? And I'll run through those very quickly. I mean, there's the very obvious ones, which of course are retail, the shops that we all use most days, cafes, hair salons, things like that, malls. Of course, you've got offices. They can be, whole buildings or strata title offices. Industrial, typically your warehouses, factories. And more we're seeing actually with the industrial, these sort of crossover properties, particularly say in Byron Bay where I live. The industrial estates almost become, it's got sort of industrial buildings with cafes in them and art galleries and restaurants and things like that, and offices and showrooms. So it's not just panel beaters and repair shops. And then you have the special purpose properties, which actually on that list I probably should have included medical, because I'm a big fan of medical properties, childcare, hotels, caravan parks, car washes. Now, essentially, all these properties can be analysed by using the same formulas. What I find is that people get a little bit bogged down. They say, oh, which type should I look at? And I find the best thing to do with that is just to start looking at properties, and you'll find that you'll end up with an affinity for one particular type, and maybe that's the type to aim for. Now, common misconceptions of commercial properties, and I love, every time I go to a barbecue or something, people say, oh, what do you do? And I say, oh, I've got some commercial properties, and I get the standard questions, worried about vacancies, or, oh boy, don't you have to spend millions of dollars to buy a commercial property? So that's actually the first one that I get. So one of the misconceptions is that they're far too expensive, and the average investor just couldn't even consider them, or certainly couldn't consider them early in their investment career. But as I'll show you in a little while, you can buy a commercial property well below the price of a residential property, even below $100,000, you know, for a small storage shed, and rent them out. So it's definitely not true. And after this webinar, perhaps get onto realcommercial.com.au and have a look for yourself. You'll find hundreds of deals, particularly below, you know, around 150,000. Here's just a couple that I've got offline in the last few days, and actually one of them's in my recent property search. The one on the top left there, a small office in Adelaide, $115,000, and some little storage warehouses, 99,000, and some other storage sheds, 114. Now, obviously, I don't want you just to rush out and buy one of these because they're cheap. You need to know what you're doing, but there certainly are some great properties around that are well below that normal starting price of residential, which I guess would probably be 250 or 350 grand at the moment. Another misconception is that, oh my God, where do I start? It's so complicated. Why would I even consider it? Well, I truly believe that commercial investing is actually a much easier decision-making process than buying a residential. Pretty much the value of a commercial property is determined by the rental income of that property, and you can really work out what a property is worth by determining the value as compared to recent sales of that type of property and the location. Now, we're always referred to net rent in commercial property, and I don't want to get you bogged down into too many formulas, but if a property, for example, had a $40,000 a year net rent, and net rent means the money that you bank after all the outgoings are paid except your mortgage. So, you know, you pay the rates, the insurance, the management fee, anything to do with running that property, the strata fee, and what you're left with is the net rent. And it's the same with residential. You know, the net rent of a residential property is after paying the rates, the strata, all those things. So if you had a figure of $40,000 net rent and the recent property sales in that area were around 7% yield or cap rate, you would quickly be able to work out that that property would be worth about $570,000. So it just makes it very easy to compare things, and you actually haven't even left your house. You're just on the computer. And the other point here is that by having this sort of formula type method, is that as the first starting point in looking at a deal, you can take every bit of emotion out there. You're not buying a property because it's got a pretty bathroom or a nice kitchen or a nice view, even though they, of course, those things add value. You're not going to be focused on that and perhaps clouded by that. It's very, very important. So I do like to say to people, you know, have ice water in your veins if you're going to start looking at a commercial property, because you're only going to buy it once and you want to buy it right. Another big misconception is that it's just simply too risky. And I guess this comes in with people saying, oh my God, aren't there, you know, I see a lot of vacant commercial properties. Well, there are in some locations, but if you just look around and start opening your eyes to it a little bit, you will always find areas that have been rented, you know, whole streets of shops that have been rented for 30, 50, 100 years even. Of course, there's going to be turnover of tenants, but if you know what to look for and know the right areas to look into, you can find a safe deal. You just really need to know what to look for and start getting out and looking for it. The other beauty of commercial property is that the buying process is actually quite a slow process. It's not, you know, sign a contract today, exchange a contract, you know, tomorrow, and 4 weeks you're settling. When you actually exchange a contract, generally speaking, you have 30 days to do a due diligence period, to do your due diligence via your solicitor. So if something turns up in that 30 days, you can pull out of the deal, renegotiate, and often I actually renegotiate, get the price down. So that's another little tip. But you need to, in summary, I guess, learn how to choose the right deal. You need to know how to negotiate. Many ways have different methods of doing that. You need to identify potential upside. So you need to know what to look for before you're actually even buying the property, because an upside could be something that could tremendously increase your wealth very quickly. Of course, you need to know a little bit about due diligence, and that's ongoing through the deal process. It's not sort of done all in one slab before you actually make an offer. And you really need to pay for quality advice, particularly when it comes to due diligence. So you need to be engaging the right, lawyer, town planners, things like that. And it's not that hard. You don't have to do everything yourself. You just need to know the steps to take. Here's just an example, actually. This is just in Bondi Road, down the road from a property I've got. And that's a very busy strip. And, if you were looking for a property that you were, going to be concerned about vacancies, these are the sort of places that you go to look at. This property's been leased for over 50 years, I think actually longer than that. The Fruitologist, I've always liked that shop. It's always got a fantastic display there. So it's about choosing these busy hubs and great locations that, for safety, that's what you're looking for. And you can buy, carefully and unemotionally. Now, as I mentioned before, we're talking about upsides, and it's okay looking at a deal just because of the cash flow, but if you can identify something in that property that no one has seen before, or no one has bothered to see, or because of changes in zoning and town planning rules, there suddenly is an upside. Now, I guess residential investors will know about this, for example, with the granny flat thing that's going on all over the place at the moment. The councils have changed the rules. You can build something else in the backyard where perhaps 10 years ago you might not have. So with commercial properties, because of their zoning, there's a huge amount more that you can do. You can have signage on a property that you can rent out. I mean, I've seen people increase their net rent by $30,000 a year just from having a sign on a main road on their building. You can build more, as I've done, on the back of properties, which essentially is unlocking a free block of land. You can buy it under market rent. I think Terry's got an example of one of those. I think that Strata office, a guy bought, under market or vacant, rents it up, then makes a massive gain on that property. Or you can buy a property that's, say, multiple tenants, and then divide that up into smaller pieces and sell bits off to either create an exit strategy for yourself, or create little lumps of profit as you move through your investment career. So very important to, three things, I guess: to have positive cash flow from day one, and we'll get into those examples shortly. Negotiate hard, do your due diligence properly, do your research on locations. Terry's research is fantastic for commercial deals as well. Because it's all about what's going on in that location. That's very important both for residential and commercial. And identify upsides. That's going to be the big boost for you.
So James, it might be the opportune time to pop in and just mention that deal that actually came through on our newsfeed. A property that's been sold, a small, it's a whole floor strata title office floor in the centre of Melbourne, which was bought 3 years ago. When it was bought, it was vacant, and they bought it for 2.2 million. And 3 years later, they've sold it for 3.15 on a 3-year sale and leaseback arrangement. So I think it's a good illustration of a couple of the points you're making. One, that there is great capital growth to be found if you know how to work commercial property. And secondly, the point you just made, that if you buy a property that can be improved in some way. In this case, it was vacant when they bought it, and they sold it. It was tenanted with a sort of a leaseback arrangement. So I thought that it was a great example of some of the points you're just making.
Yes, absolutely. And my little deal, the shopping centre, I'll show you how we've actually done that, because, I mean, look, buying vacant's not for the faint-hearted, I guess, but for people that have a few properties under their belt or in their portfolio, it's often a fantastic strategy. And I guess that guy or people that bought that property, I'd probably almost bet that they probably had quite a portfolio, and they knew what they were doing, and they got the right advice and took the punt, and you know, they've made that big win. Yeah, so that good point. But yes, I just wanted to show you a couple more little things here before we move into the direct example. So here's just an upside of one of my own properties, Pacific Street, Newcastle. Anyone in Newcastle probably know this, up the top of town. Just a cafe with an apartment above. That's how we bought it. And just a little point here, when you buy these properties with upsides like this, you're buying the property based on the income that it's getting at the time. So if someone the previous owner has ignored the fact that you might be able to build apartments on the back, you're not paying for the apartment site. When you get the development approval, which is the picture on the right, which we now have, for 3 apartments on the top, which look over the beach, you know, suddenly you've unlocked this extra value. So it can be, you know, quite substantial. One here in Bondi, bit of an ugly duckling building, I guess, but it just completed 3 apartments on the back of that property, so which was just basically a car park. It's only 5 metres wide. Whole block's only 240 square metres, so we've ended up with a shop, 1 existing apartment and 3 new ones, so quite easy to do. But this next one is a really fantastic upside that is very achievable, and this little shopping centre was actually only 1.25 million, 8 shops, very, very cash flow positive. And this guy bought this at a very high return, and he could easily divide these shops into 8 little separate shops. He could probably sell half of them and almost pay off his loan and have the rest for nothing. So, or, you know, if he wanted to get a few friends in, or there's 3 or 4 people who wanted to go in together but didn't want to be in a partnership, you could buy something like this, strata it up, and have each property individually owned and financed. So it could be a great strategy there. So just as we mentioned, buying vacant stuff, when I bought this property, it had 14 tenants, you know, so the childcare, and 13 shops, but only 3 tenants in there. So I had, you know, most of the shops are vacant, and bought the centre, you know, for 2.3 million. I think the replacement costs and the whole thing was probably over 5, and then promptly leased out 5 shops straight away to a big gymnasium, still slowly leasing up, but massively cash flow positive already. And I've also got approval to subdivide that childcare off, which would actually be worth almost what I paid for the whole lot. So
where is this one located, James?
This one's up just before Bribie Island in the suburb of Ningi, so it's not far from Ningi. Yeah, so it's in one of those sort of master plan suburbs, and as I mentioned, not for the faint-hearted, but with the right strategy and buying at the right price initially, often these deals can be bought at a cash flow positive, notwithstanding that they still have some vacancies.
So what was the potential you saw there? Because there's so many vacancies, it would have frightened a lot of people away, but you obviously saw potential in it, which you've managed to realise.
Yeah, look, I thought, okay, it really came down to the numbers. They were asking over 3 million, and I thought, okay, if I'm interested in this, I want to buy it, pretending almost that it only had 4 shops. So I thought, you know, let's just do the numbers on that, and that's what they accepted in the end, you know, after quite a bit of tossing around. So, I mean, the childcare alone, I think, is getting $156,000 net. And then I leased the 5 shops at the back. I don't know whether I can see my mouse there. I've leased them for $100,000 a year to Plus Fitness on 10-year lease. And I've got about 3 shops to go here in the front. It's all a bit of a moving ballpark, but anything that comes in now is cream on the cakes, icing on the cake.
So what sort of net yield will it be when it's fully tenanted and you're obviously heading in that direction?
Yeah, look, fully tenanted. I think and this is interesting actually, I guess you've got the net yield on what you paid for it, and then the net yield on what the value is, which is consideration. But the net yield on what I paid for it, I guess, would be pushing almost 12 or 13%.
Yeah.
And the value of the property, I guess, if I sold it with a few more shops leased, would probably be around 5 million. So, and a lot of opportunities there to strata and all that. But look, this is probably not achievable for a lot of people, Terry, initially, but it is a good example. I mean, you work your way up to these things. So probably a good time to move into some of the examples which are, you know, I don't want to put people off with big numbers, I guess.
Yeah, sure.
Now, just a note here before I move into the examples. You'll notice that I say 100% funding on these examples. Now, I just do that. What I do is I add the purchase costs up, the purchase cost, the purchase price and the purchase cost, and just lump it all in together. And the easiest way to compare other deals is just by say that deal costs a total of $400,000. Now, obviously, if you're putting $200,000 cash into that deal, you're not borrowing as much, so your cash flow is going to be higher. But all the examples here, I've worked out the numbers showing interest payments on the whole 100% funding. And I'm assuming there that most people use equity loans to provide their deposit, particularly if you're an existing investor. So from your net rent, it's the cash that comes into your bank. And from that, you pay your mortgage, and anything left over is your positive cash flow. So as I mentioned, just using equities as a deposit. But before we move into some great examples, I just want to compare a similar priced residential deal to a similar priced commercial deal. And this little one, just a little house in Beresfield, 415 grand, total cost with stamp duty, etc., say around 431. Then these numbers, they're pretty sort of, I wouldn't say they're rough numbers, but they're pretty accurate in the marketplace. If you rented that property, you're going to be getting about $18,000 per annum. You've got to take all your outgoings out of that, maybe around $6,000. So your net rent on that residential investment is going to be about $12,000. Your repayments on that loan, I'm just using for these examples interest-only loans at say 4%. You will actually get loans cheaper than that. Even commercial loans at the moment, I'm paying 3.6 on some loans, and the best on that I've heard in the market at the moment. So your repayments on that are 17,000. Of course, you're only earning 12, so yeah, you're negative about $5,000 a year. Now I know you get the benefit of negative gearing, and you're going to claim that off your tax, etc. But you've still got to kick the tin to keep that investment alive, and that's probably not going to help you get to your next investment. So let's compare it with virtually identical price commercial deal. This property was in Palm Beach on the Gold Coast, just a little office rented to employment services up there. They probably do quite well. 420 grand purchase price, cost 16, totals around 436. The big difference here is that the net income on a 3+3 lease, which means 3 years with a 3-year option, is $30,000 a year. The tenant paid for the fit out, so you don't have to spend any money there. In the lease, they've probably got it. They have to paint it every 3 years, have to carpet it, they have to look after the air conditioning. So basically, you're just collecting $30,000. Your repayments are about the same. So instead of being -5, you're actually positive 12,600. So a massive turnaround, and that, you know, that's just a great example with a similar property. And I use this same example quite a bit, and you'll be able to find these online all over the place, and people just say, wow, that's a big difference. So I think it's certainly something to consider when you're doing the numbers on a residential deal is, you know, what is your overall plan to proceed forward and get more property? It's okay buying one, but, you know, is buying that one going to stop you getting anything else? You know, it's a big thing. Lots of deals around. These are deals that are online at the moment or have just been sold. This little strata cafe in Tasmania, $230,000. Same thing. You know, positive cash flow, about $7,650. You know, great little deal. A lot of people are buying these in their super funds. Obviously, you need to get specific in their self-managed funds. You've got to get specific advice about that. But, you know, great to tuck away a little deal like this. It's probably on a 3+3 lease. One of the guys in my course just did this deal. Not so much positive cash flow in the first year, but that rent will probably grow. 250 grand property. Warehouses, you know, can be quite an interesting investment. I think one of the big takeaways I've learned from industrial and warehouses is that if you're looking at a particular location is to really have a good look around it to see if there's any more approvals coming through for any more industrial land, because sometimes you find these areas a little bit like musical chairs. Someone will throw up a new tilt build industrial development, and then everyone wants to move to the new one. So you could be left hanging if it's at the end of your lease. So it's a little tip there. This one, I saw this deal last week actually, and it's almost insane. I think, a 56 square metre unit in Bondi that sold for 1.28 million, rented at $400 a week. So this, if this guy borrowed the whole lot and took the $400 a week off that, plus took all his strata fees out, he's going to have to be putting in around $35,000 just to keep this investment afloat every year. So that's pretty amazing, especially when you compare it to this, which is that deal I showed before. One of the guys in my course bought this property, 8 shops up in North Queensland, 1.25 million. His net rent, net income on that after outgoings, that is 139,000 plus GST. Parking, there's lots of 2,000 square metres of land, and if he borrowed the whole lot, I know that this guy particularly used an equity loan to get the deposit. He's paying around 4% his income on the loan. So his repayments currently about 54,000 a year, but he's collecting 140,000. So he's banking $85,000 a year positive cash flow on this deal, and that's a pretty large lump sum of money. And I do say to people, look, there's lots of things you can do with that cash flow. Of course, the sensible thing really is to pay off your loan or pay down your loan, because if you're starting to nibble away at your loan at $80,000 a year, you're going to get that loan down quite a bit in 5 or 6 years' time, and you're therefore going to get, and of course, because of the leases, your rents are going to be ratcheting up each year. You're going to be getting the benefit of compounding. So your repayments will be lower, your cash flow will be higher, so you can even pay off the loan even quicker. So it's just a great thing. But or he might be using it to fund his lifestyle, or his partner might want to leave their job. So there's all these things away. But I also things that you can do. But I also believe that in any investment person's life, it's a great idea to develop a buffer of cash. And obviously, with this level of positive cash flow, you could easily put 40,000 a year away for the next 2 or 3 years and just say, okay, I've got a buffer of 120 grand if something goes a little bit pear-shaped. But one more thing, let's say one tenant or 2 tenants even do go out of that centre, and you're in a period of releasing, which may take you a couple of months, you've still got tremendous positive cash flow to make your payments and also spend money promoting the property as well. So there's lots of these deals around. In fact, that property was on the market, I think, for about 8 months, so at a higher price. So he just used some tactics there to get it down to a price that was exciting for him. This is a great deal actually too. Terry, one of my friends bought this, Jackie and Joe, young couple with a young baby, and they really, I guess, quite gutsy in this deal. They bought a 12-tenant building in Wagga, and this deal went on for 6 months. They took 6 months to negotiate this, and we're getting price reductions because of repairs. We kept going back and having a second bite of the cherry during due diligence periods and getting contracts extended. But they've just done a fantastic job of doing a little bit of a refurbishment, and the numbers, I know that this perhaps is out of a lot of people's price range, but they had a house in Sydney that they had pretty good equity in, and I think they used about $800,000 equity as a deposit. They essentially borrowed the whole lot just using that equity. Their net rent's $290,000. Their repayments on the total $3.3 million, 134, and therefore they're cash flow positive, about 156,000 a year. Now, part of that cash flow positivity has come from the fact that Jackie's turned some dingy old apartments above the building that were awful into fantastic Airbnb. This is the side view of the centre there. It's got a number of shops, which therefore gives you a number of exit strategies. Once again, strata titling, building above. It's got a car park at the rear. But she really got stuck into it. They live in Sydney. They don't even live there near Wagga. So they converted one of these apartments first, and we chatted about that, and she got it on Airbnb, and instead of getting, I think $300 a week rent for these apartments, she's boosted the overall cash flow by about $65,000 a year just by doing Airbnb, plus giving them somewhere to stay when they go down to keep an eye on the building. So these sort of combination properties with residential and commercial really can be quite a good thing. And in fact, I've known quite a number of people that have bought the classic terrace house style property with a cafe or something underneath, apartment above, and they live in the apartment above. And that's actually, I was saying to my nephew the other day, that's probably a better way to go for a first home buyer almost, if you can get it together. Start yourself with a dual rent property.
James, just to let you know, about 10 minutes to go to allow a bit of time at the end for questions for people. And I would remind people watching and listening that if you do have questions for James Dawson today, please type them into the chat box or the Q&A panel, and we'll do our best to answer as many of your questions as we can within the hour that we've set aside for today's event.
Great, fantastic. Thanks, Terry. So yeah, just let me know when we're going to start those, and I'll keep playing through these examples. Here's another one, a great an IGA centre. Same thing, about $1.5 million, which actually, is probably the cost of look at that apartment in Bondi for 1.2 million, but a new apartment, say in Western Sydney, some of those new larger apartments are around that 1.4 mark. They're definitely not cash flow positive, $92,000 a year. So that's a great deal, and lots of due diligence on this property. There was a lot to do on this property, so I wouldn't ever try to mislead you and say there's not stuff to investigate. But once you know how to do that, it's quite straightforward. You just need to take the steps to do it. Regional properties. I'm not sure what Terry thinks of Dubbo, but someone bought this one in Dubbo. And older properties, they come with different sets of challenges, I guess. This one's another multi-tenant property, about $1 million, and that one is showing about 41,000 cash flow positive there. So obviously things to look out for there, maintenance issues, stuff like that. So I highly recommend that a lot of buy residential properties without even going to see them. But I certainly don't follow that that line of thought. I'd much rather you go and have a really long inspection of anything you're going to buy. I know that people in residential buy properties that have got development potential, but what I generally find is that the cash flow from those properties is negative. So you're in a position where you may have some development potential, but you've got to spend, well, my last DA probably cost me $45,000. You've got negative rent happening, and then you've got to pay for the DA costs. So to me, it makes sense to get something perhaps like this that's at least cash flow positive to offset the development application costs that you're incurring. So you can, move down, and in 3 years' time or something, you can start to look at it, redeveloping it. Another cheap industrial there, $10,000 cash flow positive. Low maintenance sheds, pretty easy to purchase and nothing much to do. Medical investments, this one, a friend of mine, Caroline, bought this property. She's about 50,000 cash flow positive, and that's up in Maryborough in Queensland. And then, and actually bought it with a renegotiated brand new lease. So that's another little tactic, is to renegotiate a lease coinciding with your purchase, so that you actually get a longer term lease. In this case, I think it's 5 + 5 + 5. So we're probably moving on to the questions, Terry, but just a little point here. And, when you're looking at, and it's basic, I guess, but when you're looking at buying properties that are cash flow positive, of course, the longer you take to get them, the longer you're actually waiting or missing out on the cash flow that you can get from the property. So you just really need to educate yourself what to look for, and then start looking at deals and looking at the numbers. And that's basically what I teach in my course, is how to do that. Is really, I've condensed, I guess, my 40 years in the trenches almost. I guess there's probably nothing in property that's happened to anyone that hasn't happened to me, except I've never gone broke, but I've had everything go on, developments, tenancies, changes, maintenance, all that type of stuff. So I've basically covered off everything in my course. And actually, if you want to get some more information about that, there's a link there to another webinar, or just email Kylie, my PA. The email address is there. But essentially, I designed the course into a very step-by-step format, with easy to follow modules, all online, and manuals, taking all the steps to get from getting ready to invest right through to financing, negotiating and engaging upsides, keeping track of the numbers. Just a huge amount of resources that we're constantly adding to. So really great course that I've put together. And certainly I think if you can get everything in one location, it's definitely a benefit to you. And we also have actually monthly online property searches that I personally handpick a whole heap of different deals. And these just give people, some people go out and actually buy these deals, but more often than not, it just opens their eyes to different styles of properties and different locations. And I put my comments on each of these properties that we look at, and they are really helpful to the group. And there is a private Facebook group as well, which is super supportive. So if you are interested in that, just contact Kylie or have a look at the webinar, and you can go through all the details there as well. And that's just a picture of our property search there. So we could probably move into some questions, Terry, if there's anything there.
Okay, James, thank you for that. And just remind people, if you've got any questions for James today, please type your questions into the Q&A panel or the chat box. We've got lots of questions myself. One of my questions relates to the purchase cost. You did in many of your case studies, you did list the cost. They didn't actually seem particularly high, and I'm sort of wondering about the components of that. Barry's actually asking the question, what is the percentage you use? Is there a basic percentage you use for the cost factor when you're doing your sums?
Yeah, so look, as a rough idea, I know myself and a lot of investors use about 5%, which covers perhaps stamp duty, legal fees, building inspections. On those examples there, I use an online calculator for the stamp duty. No stamp duty on commercial property in South Australia, so that's interesting. So it's a sliding scale. It's the same amount of stamp duty as on residential, the same sliding scale. And then legal fees, there's sometimes a little bit more legal fees with commercial properties, just depending how involved the leases are. But with those sort of rough numbers I use in the examples, I think I'm fairly accurate for each of those deals. So if people are replaying this, they can have a look at that and check those out.
Okay. Mark has got a question about the cap rate. Just wondering if you could explain about cap rates again. And I also thought you made a number of references to net rents, which means the tenants pay the outgoings. Not sure where everybody out there watching and listening really understands what outgoings are and why that's such an advantage with commercial property. They're paid by the tenant. Yes,
so I guess just on the net rent discussion, I think most people with residential properties, someone says, oh, I'm getting $400 a week. They often, and I've probably been guilty of it as well, they delude themselves that they're getting, $400 a week going into their bank. But of course, you have to take your outgoings out of that. So you do have, the rates for the property, the insurance, the managing agent fees, the body corporate if there's strata involved, maintenance, and of course vacancy as well. But with commercial property, there's a couple of ways writing it in to leases, but essentially generally speaking, a tenant will sign a lease and it might be, say, $30,000 a year plus outgoing. So in that situation, every time a rates notice or insurance bill or something like that comes in, whatever's written in the lease, whatever's documented in the lease, you send that on to the tenant and say, look, here's, as agreed, here's the rates notice. You now have to send me a check for the rates, or of course your agent will do that. So in that situation, the $30,000 that you're banking is the net rent, and the tenant's effective rent might be $40,000, but your net rent is $30,000. And there's another way of doing it as well. Sometimes a lease will be what's called a gross lease, which means in that same example, I'd be getting paid $40,000 a year, but out of that 40, I would be writing the check or transferring the money for the outgoings, but my net rent is still $30,000. So valuers and commercial investors always use the net figure. They don't work on the gross figure. I mean, you know what the gross figure is, but when you're calculating how that investment is going to perform, you're using the net figure as the basis for all the calculations. So then moving on to the cap rate discussion, Terry. Cap rate and yield are pretty much the same. They're sort of interchangeable, and how they're used is if you had a property that was $1 million and you were getting $100,000 net rent, that would be a 10% yield for you, or a 10% net return, same thing. And then if a valuer was looking at that property and comparing it, he would say, oh, that property sold to Terry Ryder at a cap rate of 10%. So it's sort of all the same thing. But when you're asking an agent, for example, of recent sales, most people say, well, look, what is the cap rate of the recent sales? But they could also say, could you tell me the yield, the net yield of recent sales? So it's a little bit confusing. There's sort of those three terms that are a little bit interchangeable.
One of the things that I think is worth perhaps focusing on a little bit more is that it's standard with a commercial property lease to have built-in rent increases. They're actually built into the agreement, which is something that you don't typically have with residential.
Yes, that's right. And I think with most residential owners, and myself included, you know, the rent increases are a little bit, I've got some apartments and stuff, and they're a bit ad hoc. You know, when a tenant moves out, the agent says, oh, I think you can get another $20 a week or something like that, or it's got to go down $20 a week, whatever happens. But when you negotiate a commercial lease at the start of the, during the negotiation, there's a couple of common methods of the increases. And one of them is according to the Consumer Price Index, which currently what's running at maybe 1.9 or something percent. So every year you get the Consumer Price Index calculation, and you write a note to the tenant, or your agent does, and says, according to your lease, your rent's got to go up 1.9%. But generally speaking, most people now like to have a fixed percentage. And generally, I find it's around 3%. I find that 4 or 5% is probably a bit heavy, because you're outstripping inflation. And I don't believe in screwing tenants. You know, they're almost your business partners. You want them to be really firing. So I find with leases that say have a 4 or 5% fixed increase, that after a few years, sometimes they've outstripped the market. And, you know, really the increase is designed, particularly with a CPI increase, is to keep your rent up to a market value. So if it's market value at the start, goes up a little bit each year with inflation, then it should be market value in 3 years, particularly speed. But, you know, that can change too. If that market becomes very strong because the area's become trendy or something like that, well, then you get the opportunity in your lease at certain intervals in the lease to do what's called a market review, where you actually do a comparison of similar properties rentals in that street or location, and the tenant then has to agree to have that rent increase to market. So, but that's the beauty of the lease. You know, everything is set out in the lease. The tenant should, and I always insist upon it, that they get legal advice when they sign a lease, so everything's very clear to them. Saves a lot of drama later. And of course, you as the landlord should read the lease thoroughly. And the leases today are pretty much plain English, and they're very straightforward, and they also have clauses in case there's an argument how to sort it out.
James, perhaps we could just go back and touch on one of the concerns that I've heard some people express about commercial property in comparison to residential. With residential, in most cases, you lose a tenant, it's relatively easy to find a new one, and that's a fear people have about commercial, that it's harder to find a tenant and you can have longer periods of vacancies. I actually had that discussion with a customer when we were doing a strategy session yesterday, and I thought, in their circumstances, what their goals were, that commercial property was ideal because cash flow was particularly what they were looking for. But when we talked about commercial, their great fear was having long periods of vacancies. So is that something that you find that is a bit of a barrier for people in considering commercial?
Yeah, look, it definitely is a barrier, and it's a very valid concern that you have to address. I believe when you're choosing the property. So, I had someone comment to me a few weeks ago. They were in a street in Sydney, and they said, "Oh, there was 5 vacant shops out of 10 shops." And I said, "Well, I probably wouldn't be buying there, but have you investigated why they're vacant? Is someone just about to redevelop it?" So there's all these sort of little points that come into play. Sometimes you'll see a heap of vacancies and it's because they're getting redeveloped. But it's very easy to see. I know people listening to this, if going for a coffee tomorrow morning where you normally go and sit in a cafe and have a coffee, have a look what's around, have a look at the shops that have been there for a long, long time, or have a look at some of the areas that are vacant. And if there's a lot of vacancies and you're concerned about that, I wouldn't be probably recommending to buy in that location. But apart from that, if you were looking at some shops, and let's say you were looking at a shop that had a hair salon in there, for example, not that we'd be visiting, Terry, but the thing is, if you had a hair salon that been there, say 30 years, and I've got hair salons, so I like them as tenants. They're shops that people have to go to. It's like dentists, maybe not the paper shop, but doctors, hair salons, things like that, where people physically have to go to. And often you'll find that those style of shops have had the same business, maybe not the same tenant, but the same business, particularly cafes, and they've been there for 30 or 40 years. So if you're looking at one of those and the agent can give you a history that goes back at least 5 or 10 years and it's been constantly rented, it's a pretty safe bet that's going to be rented in 5 years' time. But the big point is the rent correct? So you'll find generally with shops like that have had a long-term tenant, maybe 5 or 10 years, you'll generally find that the rent is around the market rent. It's not too low, not too high. That's what we want to check. But you wouldn't want to buy a premises, for example, that's got a new 2 or 3 year lease. And when you look at it, you find that the rent's 20% above market because you'll be paying too much for that premises, and probably the tenant's going to be struggling. So there's all these little sort of things involved. But I guess in short answer, it's about buying the right property in the first place and taking your time, and particularly even if you agree to a price and gone to contract on a property, that during that due diligence period, you really hone down and make sure that this is going to be the deal for you and that, it's going to be a pretty safe bet. But if it does come vacant, you might have 3 months. And if it's positive cash flow, you need to, and it's the benefit of positive cash flow, you have your buffer there and you move on, you get a new tenant and you might even do better.
There's a question coming from Ashdown. Good question too. How do you find out how long a commercial tenancy has been operating? So how do you find out some of the history of your tenant to give yourself some comfort, I guess? Yeah,
look, a great question. And I really believe this is sort of right down into the granular nitty gritty of looking at deals. So quite often what I do is, is visit the location, several times, over a couple of different weeks, different days. And more often than not, I end up talking to the tenant or tenants next door. I mean, of course, you're going to be asking the agent for history of the tenant. Not that, obviously you need to check all those things and double check. You don't want to just take everyone's word for it. They might have a tenancy history and leases going back 20 years. That would be great. They might have payment history going back, 5 years. Even, 2 years payment history is better than nothing. But, just talking to people, local business people in the street or location within, or, of course, it's different with different types of businesses, offices, for example, compared to retail. But yeah, I really believe just get down and ask people. Local valuers are always a great source of knowledge. I'm always amazed how much information they will give away if you're prepared to pick up the phone and get a good one to chat to, because they don't seem to chat with anyone. They're always just in front of their computers. So, they'll say, oh yeah, that property was on the market 2 years ago, or those people went bust, or, those people have been going great. All those little bits of information are going to help mitigate risk. So that's a great question.
James, we've got just a minute or two left, and I thought I'd end. There's a couple of people who have been watching and listening today who have actually made a couple of comments. I think it's a great way to lead into the final segment of today's broadcast. Frederick has said, just letting you guys know that this is so helpful and it's so inspiring to listen to James's deals, and I'm very keen to get started now. And Julie has typed in, Frederick, I agree. So we've got a couple of listeners at least very keen to, having listened to your presentation, James, to get started. So I thought it's a good entree for you to perhaps end the broadcast by just telling us again a little bit about the course that you offer to help people like Frederick and Julie get started and go about it the right way.
Yeah, absolutely. Well, thanks for those lovely comments, you guys. Look, initially, I think the best thing to do, if you've got the link on the bottom of the screen there, which is www.commercialinvesting.academy/ just try and get that correct, that web address. That is a full webinar that runs through all the details of the course. And basically, I've tried to sort of summarize everything I've been doing for the last 40 years into one neat position. And, I've been in the game basically since I was 18. So I'm 63 this year. So I've been hammering away for a long time and still very active. It's a great business to be in. But if you just want to get more information and just touch base with me, you can also just email Kylie Harris at jamesdawsonproperty.com.au. Kylie's my PA. And we can put something together for you and get some more information for you. But essentially, the course is designed to help you get a great deal. So it's to find a property, a good property, identify the upsides, be able to negotiate a great price, get help when there's some dramas in that negotiation perhaps, or something happens that you don't know about, and then move on to, financing that property, engaging. Well, we don't sell properties. We just show you properties and I teach you how to do it, but I'm certainly in no way selling you a property. So that's probably enough for the moment, Terry.
And Sandy's following up. She says, absolutely sensational. And I agree. It's been a great presentation, James. And she also asked, or he or she, Sandy, do you help buy properties, James? And I think, as you've just said, you don't sell actual properties, but I think you do help your students to find good opportunities, including the compilation of available deals that you put together.
That's right, and we certainly have some good people in the team that can help with actual purchasing a property, should people want to have a sort of more done-for-you approach. So that's something, once you get into the course, we can chat about that. But just one thing on that, I think anyone investing, and these are major life investments, you really need to know what you're doing. And even if you want to leave the negotiation up to someone else, to have the background knowledge is so important. I just can't stress that enough. It's just super important that you have the background knowledge. It's just going to make you have a much less stressful experience, I guess, and buy a better deal. Look,
I couldn't agree more, James. I find I deal mainly with mum and dad investors interested in residential and property investments, and what really scares me about the whole industry out there is that so many people are trying to do a property investment on the cheap. They're not willing to invest a lot of time. They're not willing to invest any money to improve their knowledge or to get good advice. And I strongly urge property investors of all types to get beyond that mentality. It's the worst kind of false economy. It really is worth putting in some time and money to do it properly by educating yourself and by getting on board with some really good advice. If you're interested in commercial property investment, that kind of advice is available by picking up the phone or dropping an email and talking to James Dawson, who's one of the acknowledged experts in commercial property investment around Australia. And I thank you, James, for a great presentation today. I've learnt a lot. I think you've dealt with many of the misconceptions that are commonly held by people, such as that it's too expensive. Well, you've shown that you can buy for even less than $100,000 to get started with commercial property investment. It's not as complicated. In many ways, it's actually a lot simpler than residential property and not necessarily risky either. There's many advantages, particularly with the lease structures, that make commercial property a really strong potential for property investors to consider. A lot of information there today. Anybody who's registered for today's event will receive a copy. We've recorded the broadcast and we'll be sending that broadcast recording out to everyone who's registered today, including those who weren't able to watch it live. And I do urge you to follow up if you've got questions or interest in finding out more, to make contact with James through the email address on the screen and also the website address on the screen. So, James, thank you again. Great presentation. Really enjoyed it. Found it really interesting and informative. And let's do it again soon.
Great. Thanks so much, Terry, for having me on, and thanks everyone for listening, and hope to hear from you soon. Thank you.
Okay, and thank you, everybody. This is Terry Ryder from Hot Spotting signing off. Let's do it again soon.
Thank you.